I recorded this video in mid-2024, and for months, insurance companies have been raising rates somewhat indiscriminately and unfortunately delivering that bad news to their clients at the very last minute without a lot of explanation. If that's happened to you and you're thinking of forming a captive, then this video may be a good starting point in your discovery process. Hi, I'm Coyle. Welcome to my channel where we talk about the risk and insurance issues on the minds of business owners. As an expert business insurance broker, these videos are intended to help guide and educate decision makers to help make you a more informed insurance buyer. If I don't answer the question on your mind that brought you to this video, reach out and let's connect. I'd love to hear from you. Oh, and if you find this video helpful, do me a favor and hit that like button and subscribe. Okay, so what is a captive? Why and when did they start, and who are they for? Captive insurance has been around since the 1950s when Fortune 500 type companies with plenty of cash thought there must be a better way to transfer risk off their balance sheet without paying a commercial insurance company what they considered at that point exorbitant prices. Today, captive insurance companies exist in a variety of flavors, if you will, to accommodate the needs of their owners. In a very basic sense, a captive insurance company is the insurance subsidiary of a larger parent company. There are two different entities with two different books and records, and the sole purpose of the captive is to insure certain risks of its parent company. Captives can be formed by companies with commercial insurance premiums as low as $350,000 and as large as premiums in the hundreds of millions of dollars. So it sort of begs the question, who should form a captive insurance program? Well, there's no hard and fast rules as to the premium size, but as I mentioned, we see captives being formed for some companies that are paying around $350,000 a year in commercial premiums, but generally it's more common to see captives being built around companies that are paying around $1.5 million a year or greater in commercial premiums. Often, companies that seek out captives are those with higher hazard or higher risk profiles, which typically mean higher insurance premiums. But one key element, regardless of size or risk profile for a successful captive program, is that the company must have two things. The first is a history of good claims performance relative to the premiums they pay. Typically, we're targeting clients who have managed their 5-year loss ratio, which is the sum of their 5 years of claim dollars incurred divided by the 5 years of premium paid, to be less than 30%. The second element is that the 30% or lower loss ratio is not just the result of good luck, but that the insured has a solid risk reduction and risk management plan in place. Without this, pure luck will only go so far and not produce the long-term results you're really looking for. Good claims performance is often rooted in company culture. The other key element before beginning this journey towards a captive is the company owner's understanding and tolerance of risk. It's important to be plainly simple here. You are putting capital at risk, and potentially a lot of capital. If the company owners can't stomach paying the company's claims out of their captive's pocket to a degree, then a captive may not be right for you. I said to a degree because most captive structures will cap or limit the amount the captive will pay in any one claim, as well as for all claims during the course of the year. Lastly, the idea of a captive is a long-term commitment. It's not something that you'll form for your next renewal to solve the market conditions today and jump out of when the insurance marketplace rates soften up. Generally, this is a long-term commitment. What drives companies to form captives? Well, the entrepreneurs I speak with about captives all have one thing in common. They feel like their insurers are getting away with murder. They feel like their insurers are carting away buckets of cash from their account year after year with low to no claims and high premiums. They hate the last minute surprises, and that's what motivates them to think about forming a captive. They want more control. What are some of the benefits of a captive? Well, many business owners start with the idea that if they form a captive, their premiums are going to go down. But in many cases, that just doesn't happen. The premiums your company will pay its captive may be similar to those that you pay the commercial insurance marketplace, and on top of that, you'll be paying other costs for starting and managing the captive. So it's important to understand right off the bat that this may not be a money-saving strategy. It could be, but it's not necessarily. What I prefer business owners to think is that a captive can help create pricing stability over the long term, and this is due to isolating yourself from the vagaries that occur in the commercial insurance marketplace. One of the biggest benefits of a captive is that underwriting profit, the premiums that are left after paying claims and operating expenses, is the captive's profit and not the profit of an insurance company. That profit may have some lucrative tax benefits that we'll talk about in future videos, but for now just consider that your insurer is not walking away with bags of your cash. Your captive is. Finally, your captive may be able to broaden existing coverages beyond what's available in the marketplace and give you protection that was previously unavailable. How do you get started? Well, without sounding like a sales pitch, I think the first step to getting started is having a conversation with us. There's probably dozens of questions on your mind and we can help answer them. Depending on the premiums you're currently paying, there may be a somewhat simple approach to understanding the feasibility of deploying a captive, and that will start with looking at 5 years of premiums and 5 years of loss runs. Loss runs are reports issued by your insurance company that detail each claim reported to them and how much was paid out. By evaluating kind of the back of the envelope calculation of total claims incurred divided by the total premiums paid, each line of business may give good insight into how feasible a captive is. From there, a more formal feasibility study may be needed to evaluate your options. As I've mentioned at the beginning of this video, captive insurance companies can be structured in a variety of ways to insure a variety of risks. What is the right design for you will be based on the risks you wish to self-insure in a captive, your premium and your loss history, and other underwriting factors. Again, I'd like to reinforce that a captive isn't right for everyone. Company owners need long-term thinking and the ability to stomach risk and potential loss of capital. There also needs to be a high degree of confidence in the company's risk management strategy. If all those things align, then a captive may be a tremendous asset to implement. If you want to learn more, give me a call and let's chat. I'm happy to answer any questions you may have and get the process started. My contact info is in the description box below, and I'd love to hear from you. Thanks for watching.